Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-strings support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. In this edition of the Moneymakers podcast, I take the opportunity to have another catch-up with Ashley Thomas, who is the renewables and infrastructure analyst at Winterflood Securities. He was on the podcast a few months ago, and I thought it'd be a very good time to ask him back, however, because since then, we've obviously had a number of interesting developments that have affected the renewables sector in particular, and that is we've had the ongoing Iranian war, where there's a ceasefire at the moment, but no immediate prospect of a resolution, but also a series of changes in the regulations and government policy surrounding renewable energy infrastructure. And I thought we might go through with those. You could give us an explainer of what's been announced and how that may or may not affect the renewable trusts that we follow in the investment trust sector. So, on that basis, can we just kick off then by talking about the Iran war? Obviously, we know in broad terms the impact, what that's been. It appears to mean higher inflation and in the short term has produced higher bond yields. And of course, it had an impact on power prices. So perhaps we could just start by asking you to summarise overall the impact that the Iran war has had so far on your sector. And then we can go through some of the other more detailed questions after that.
Yeah, of course. Well, I think firstly, if we start with energy prices, because the damage that we're seeing to the regional oil and gas infrastructure and also the blockade of the Strait of Hormuz has driven up 2026 and 2027 gas and then in turn power prices. At its peak, UK gas prices for this winter nearly doubled from about 80 pence a therm to 150 pence a therm. And if we look at UK winter 2026-27 baseload electricity prices, i.e. for this winter coming up, they increased by 50% from £75 per megawatt hour to over £110 per megawatt hour. Now, with the ceasefire that's been declared, gas and power prices have come off their peak, but they're still elevated. So if we look at this winter, power prices are currently up about 27% since before the conflict, at around £96 per megawatt hour. And as you mentioned, Jonathan, it's not just energy prices, that then has a knock-on effect to inflation. So if we look at 1 year break-evens, a measure of RPI inflation expectations, they've increased to around 5%. So as a renewable electricity generator, your near-term cash flow expectations will have increased, because the price you achieve on selling the electricity you haven't already sold forward or hedged has increased. The hedge profile differs per renewable trust, with Greencoat UK Wind being the most open or unhedged, as well as receiving that higher level of inflation-linked subsidies. Now, if we look at the duration of that effect, at the moment, the expectation, if we look at prediction markets, is that the blockade should be eased as we get into the second half of this year, but that will still have a knock-on effect through to next year. So even for next year, power prices are still about 16% higher than they were before the conflict and about 8% higher than they were before the beginning of the year.
And that's what the prediction markets think, but that is a kind of indication of the potential level and the potential duration. Obviously, we don't know for sure what's going to happen.
We don't know for sure, but that's both the prediction market and the energy market suggest it is principally a 2026 and 2027 effect. If we look through to 2028, then actually current power prices are actually lower than they were at the beginning of the year. So at the moment, it's those 2 years, but as you say, it could end up being more protracted. We don't know at this stage.
Okay, so the other factor there, which you haven't mentioned yet, is obviously higher inflation feeds through to the benefit, to some extent, of the renewable investment trusts. But we're also experiencing higher bond yields, and that must increase the kind of discount rate at which revenues are discounted over the next few years. So is that another effect, or is that already encapsulated in what you've just said?
No, so that's another effect. So if I look across the renewable energy trusts, then the effect of higher power prices on average should have about a 2% positive NAV effect. That ranges from around 0% to about 4%. Obviously, the near-term impact on cash flow and dividend cover will be greater because your NAV is a longer-term discounted cash flow, but about 2% NAV value accretive. The benefit from higher inflation, again, bigger benefit short-term, but on NAV, on a longer-term basis, is about 1% value accretive. But with bond yields having gone up, we've had 30-year UK gilts up about 60 bips. If that was reflected like for like in higher discount rates, then actually that would offset that 3% net valuation effect. So that's for the renewable trusts. Broadly, it's cash flow accretive, but broadly neutral from a valuation point of view. For the infrastructure funds that ex-GCP infrastructure don't really have power price exposure or little power price exposure, the combined effect of higher inflation and higher bond yields on average is about 3% negative NAV valuation effect. So broadly speaking, at the moment, higher energy prices are more positive for renewable energy cash flow and broadly neutral on a NAV valuation basis, but marginally negative for infrastructure funds, principally from higher bond yields.
Okay, so perhaps we could just take a look at how the sector has actually performed since this all started. I mean, I'm looking at some 1 month numbers, okay, so it's not quite perfectly aligned with the start of the Iran war. And that's been broadly supporting what you said. I mean, essentially, the share prices of renewables generally seem to be up a little. One or two have done particularly better than others. But also one or two of the infrastructure trusts have also gone up. So it's a bit of a mixed picture. But are you surprised by the extent of the changes that we've seen in pricing in your sectors over the last month or so?
Broadly speaking, no. So broadly speaking, there has been this rotation. So historically, we've had a number of years where it's been a tough subsector for renewable energy investment trusts, and the more defensive infrastructure funds have broadly outperformed that subsector. We did have that rotation back in March, and that's continued broadly into April. And as I say, that's not sort of too surprising. Within that, we have had some company specifics. So within that period, I guess we've had Next Energy Solar announcing a lower dividend. We've had Hickle announcing 2 value accretive transactions, a disposal and an acquisition. But broadly, in terms of the subsectors of renewable energy doing a bit better than infrastructure, that's to be expected given where we are with energy prices, as long as we don't continue to have an affordability response from governments in terms of policy measures.
Right. Well, let's come on to those policy measures, because obviously, just to complicate things, it's not just the case that we've had the impact of the Iran war and general macro conditions. We have also had a number of announcements coming out of government about energy prices. I mean, back in the budget, for example, at the end of last year, there was a change in the cost of renewables obligation designed to bring down energy bills and shift some of the cost of energy bills onto taxation. And then in the last 10 days or so, we've had a couple of further announcements. The withdrawal of the carbon price support mechanism. I'm sure all our listeners are familiar with that one. And then more recently still, some further changes designed to break the link between gas prices and electricity, including an increase in the electricity generators levy and an introduction potentially of a voluntary new CFD auction. Now, that's a lot of technical terms there. I'm hoping you can explain it all to us in simple terms that laymen can understand, and then go on to say whether that also is having an impact or what sort of impact that's having on the renewables. So I don't know how you want to do this, Ashley, but can you just set the context then of what the government is trying to do with all these changes, and then we can look at the detail.
I think the context is, if you look at the spike that we've had with energy prices, energy bills next year are expected to increase by around £200 to £300 for the average household. So it's notable that with the most recent government announcements, the Labour government is no longer talking about a £300 energy bill cut. They're talking about trying to stabilise energy bills. So given that backdrop of higher energy bills, the traditional trilemma of decarbonisation, energy security and affordability, it's understandable that greater focus is being placed on affordability. So I think that's the sort of the backdrop of why we've suddenly seen a number of policy measures come out from the government, and I would expect that focus to remain. The carbon price support, I guess, was the easiest policy lever for the government to pull. So this was a sort of supplementary carbon tax introduced back in 2014 when carbon prices were low. The intention was to try and get the UK carbon price above £30 per tonne, try and push coal off the system. It could be argued that it had done that job. So coal came off the system back in 2024. UK carbon prices are currently around £50 a tonne. So, sort of both of those boxes have been ticked. But also with less thermal power generation on the system, the amount that tax raised for Treasury had reduced. It reduced to about £400 million a year, but was costing the system, was costing sort of you and I as consumers and businesses about 1.5 billion. So by removing that supplementary tax from April 2028, it should produce a saving for UK consumers, albeit I would still note that the Labour government has a longer term intention to align UK carbon prices to EU carbon prices, so they could still increase in the future, but near term there should be this saving. So that's why the UK government pulled that lever. The impact for renewable trusts is relatively marginal. Varies from about 0.5% to 4%. Greencoat UK Wind, sort of most exposed, but it's marginal. Will be reducing their power price forecasts between £2 to £4 per megawatt hour. I guess that was the most straightforward and most expected policy response that we've seen.
So then we've got this other changes that I mentioned there. So the increase in the electricity generation levy and the voluntary CFD auction. And these are all part of, as I said, an attempt to break the link between gas prices and the electricity price that we all pay. Because at the moment, the marginal change in the gas price is what drives the cost of electricity, is the most important factor in the cost of electricity in this country. Have I got that right?
Yes. So the government announced two initiatives, and effectively it's a carrot and a stick. And it was even explicitly couched in those terms by the government. So the stick is the electricity generation levy. So again, this was a supplementary tax introduced in response to the energy price spike we saw with Ukraine. So came into effect in January 2023. And it's a supplementary tax on electricity generation above a certain power price level. Now that level hasn't changed. That level was £75 per megawatt hour 2024 money. That's around £83 per megawatt hour currently. But what the government's done is two things. They've increased the rate from 45% to 55%, and that's effective from this July. And then that tax was supposed to expire in April 2028, and it no longer has that expiry, no longer has a sort of sunset. Actually, because they haven't changed the threshold, with energy prices where they are at the moment, just increasing the rate doesn't have a material effect. It would have had a material effect if they brought the threshold down, but just increasing the rate doesn't have a material effect. And we've had a number of trusts come out and say that they don't expect the increase in the EGL to materially impact NAV. Now, I've seen some analysis from Regen saying that actually that 10% increase, if we had a Ukraine situation again, would reduce revenues by about 6%, but just where we are at the moment, the impact is less than 1%. So both our analysis, third-party analysis, and the announcements from the trust suggest that actually the EGL itself won't have a material effect. So the government has couched this increasing tax as a stick to encourage generators into this voluntary CFD auction, but actually there's not that much effect in it. So it could be that we see additional changes. But the carrot that the government has offered is this voluntary wholesale CFD auction that they will consult on later this year and hope to put into effect in 2027, potentially to go live from 2028. And there, this voluntary CFD is that if you're a low carbon generator, so not just renewables, but also nuclear and potentially waste to energy, you could swap your uncertain power price revenue exposure for a more certain CFD contract with the government or with the low carbon contracts company. And so the attraction there is that clearly having greater certainty of that future revenue could potentially support a lower discount rate and also potentially support a higher level of gearing or debt. So I think that's the attraction for the industry. We still need all the details. What the government would want is, if there is value that is potentially being created for the generators, clearly the government would want to share in that value. And so it would be looking for a lower strike price. It would be looking to set a lower power price. And on our calculations, working through a lower discount rate, we think that to be NPV neutral, to be NAV neutral, could potentially support a 20% lower power price. So that's the value opportunity. We don't yet know how that strike price will be set or over what tenure. I was working on a 10-year tenure. We also have an issue that, as it stands at the moment, the government's forecasts from last year of longer term power prices from renewables is generally lower than a number of the renewable funds' forecast power prices. So if I look at what's called the reference price from the auction that took place last year, AR7, and I look out to 2032-33 for onshore wind or offshore wind or solar, the government's forecast of where they expected renewable power prices to be in those years is potentially 40% below some of the renewable trusts' forecasts in those years, albeit for some of the more conservative power price forecasts, it's only about 15%. So, I guess there's two elements there. One is, how does that value share potentially get split between the generators and the government? But also, where are current forecasts that drive the NAV versus probably government's expectations of where they would like to set power prices in the future from renewable generation such as wind and solar?
Right, so it's a complicated picture. The effect of the wholesale auction, if people go for it, as you say, it would allow the generators to exchange the certainty of a guaranteed revenue for perhaps a larger proportion of their generation, and that would bring down discount rates and so on, as you say. But we're not clear, or at least I'm not clear, whether that would be a net positive or net negative for the generators if you take those various effects into account. While at the same time, your last comment saying that the forecasts made by the generators themselves are higher than the ones the government would obviously wish. So there has been an issue around power price forecasts in the past. Do you have any idea at the moment, or any intuition at the moment, about what the generators will do in response to these initiatives, and whether indeed that means that the outcomes that they will be forecasting, and therefore their NAV valuations, will be potentially lower than they are now?
Well, it is a voluntary auction. So I guess at this stage, there's a stick, but it's a relatively ineffectual stick. So at the moment, it's an option. And an option potentially has value because they could go into that auction. The government may have a view on the price that they're seeking, but generators are not being forced to participate at a set level. So I guess the option in itself has value. In terms of longer term power price expectations, we still may see the current government continue to accelerate the deployment of new renewables. So in response to this crisis, affordability is an issue, but energy security, energy independence remains an issue. Last year's auction, AR7, was bigger than expected. The government put more money, contracted more capacity than expected. That has a dilutionary effect on longer term power prices. And then in response to the Iran conflict, the government has announced that the current round of auctions, AR8, the timetable will be brought forward. And it is possible that, again, the government looks to procure more capacity. So if we continue to add more low marginal cost renewables, then my expectation would be that longer term power price forecasts come down, as long as the gas price impact from Iran is relatively short in duration, effectively a 1 or 2 year effect.
So just to be clear, when you say that the prediction markets are predicting lower gas prices after the Iran war kind of finishes, we hope, are those forecasts lower than the ones that the generators themselves are making when they're making forward projections? Because obviously I'm coming around to this issue of the discounts that all these things trade at, and whether or not the forecasts that the generators are making are in fact too optimistic, notwithstanding the short-term issues that we've seen arising from the Iran war.
I'm not avoiding the question, but my response is depends. And the reason why it depends is that different trusts use different forecasts. So broadly speaking, Greencoat UK Wind uses just one forecast that is the most optimistic. And if I look out to 2028 and beyond, certainly for 2028, they're above where current futures or forward markets would suggest. At the other end of the spectrum, GCP Infrastructure uses just one forecast that is the most conservative. And actually, that power price forecast is broadly in line with where we are for current futures or forwards looking out to 2028. The majority of the market uses a blended average of 3 and is therefore in the middle. But certainly, if I look at Greencoat UK Wind, their power price forecast is at the higher end and higher than market expectations for 2028, and certainly materially higher than the government reference price looking into the 2030s.
You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector each week and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content weekly newsletter, now available with a 2-week free trial. There you'll find our in-depth, independent profiles of more than 200 investment trusts and much more content. Go to money-makers.co/circle for more details. If you like this podcast, do please subscribe to the channel and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Find all those links on the website, money-makers.co. When I look at the renewable energy sector at the moment, and we look at the issue of discounts, according to the AOC numbers, I don't know, yours may be slightly different, the average discount is 32%, taking all these trusts, and that's a range between 26%, which is Greencoat UK Wind, and significantly higher for some others, US Solar, for example, 53%. Somewhere in that range, typically. So we know that that's been the phenomenon of the last 3 or 4 years. I guess the question really to ask is, A, are those discounts still sensible? In other words, do they actually reflect what the market thinks these things are worth? And secondly, are they likely to come in or go out in the current circumstances? In other words, what could shareholders reasonably expect to see as far as discounts are concerned in this sector?
So are they sensible? One of the funds, Bluefield Solar Income Fund, is currently progressing a formal sales process. So we should hear over the coming weeks, hopefully the conclusion of that sales process. But I would expect a sale to be achieved below the NAV. Now, it could be at a 20% discount, but my expectation would be that even for that fund that has an attractive development pipeline, the market price of that fund is below the NAV value, albeit tighter than the average renewable fund is trading at. So is there downward pressure on the NAVs? I think because of higher discount rates and potentially lower power price forecasts over the medium to longer term, yes, I think there is still downward pressure on the NAVs, and that's why we have such material discounts. The other point I'd make is that within that universe, there's different qualities of assets, but there's also a different geographic mix. So in terms of quality of assets, there may be some companies that are less exposed to power price forecasts or to wholesale power price markets, or less exposed to the UK, which has seen a greater degree of government and regulatory intervention and a greater spike in the risk-free rates, UK gilts. And therefore, I think potentially that downward pressure on NAV is felt to a greater degree for some of the UK-focused funds than those that are more diversified either geographically or potentially within their portfolio, that aren't monoline renewable funds.
Okay, so next question is, are those dividend yields secure? I mean, the dividend yields are, again, according to the AIC figures, averaging 10% now, which is a significantly robust figure, I think one could say. How secure are those dividend yields? Because that's obviously been the main reason why people bought them, I think, in the first place. What can we say about that, to the extent we can say anything at this point?
So over the longer term, I would still have concern over dividend sustainability of some of the monoline renewable funds. Historically, we'd flagged the UK solar funds. Next Energy Solar has flagged a potential dividend cut. Bluefield Solar is going through a sale process, so we don't really have visibility over its longer term dividend sustainability. But effectively, if the funds don't invest in the assets, then given the maturity profile of their portfolios, you would see a reduction in cash flows over the longer to medium term, which would put pressure on the dividend. I think the benefit from higher energy prices, even if it doesn't have a material impact on NAVs because it's a 1 or 2 year effect, is that it will improve 2026 cash flows. So actually, whatever pressure they may have been feeling over the medium term, certainly for this year, cash flow and dividend cover should be better than expected. For the likes of Greencoat UK Wind, we estimate their dividend cover could be 0.2, 0.3 times better as a result of elevated power prices. So I still feel that over the longer term, some of the monoline funds do have potential dividend sustainability concerns, but actually with higher power prices, that near-term pressure should be alleviated because dividend cover should improve.
So a bit of a reprieve from that otherwise potentially negative factor.
Yeah.
And one of the things that Winterflood does, I know recently they've got this new wonder tool that allows you to track kind of flows in and out of the sector. And I wondered what has actually been happening with the renewables and perhaps also the core infrastructure trust. What have been the trends that you've seen in the flows into and out of this particular sector?
Yeah, so we have the Winterflood Retail Intelligence product, which should track over 97% of retail execution trades on the UK market. What we saw last month in March during the conflict was continued strong retail buying support for the renewable sector. Overall, the net flow was a small net negative value, but the absolute level of retail buying was the third highest across the AIC sectors. And within that, the trust with the strongest retail buy and a relatively strong retail buy skew, i.e. the proportion of buys versus sells on a value basis, was Greencoat UK Wind. So having outlined that higher energy prices are positive to valuations, positive to cash flow, we saw retail buyers also recognise that, and Greencoat UK Wind has got the highest positive power price exposure within the sector. So that's what we saw on the renewable side. On the infrastructure side, it was less positive, although if I look back over the past year or so, infrastructure still remains a relatively positive and attractive element within retail buying. So it generally appears towards the upper end of the table on both absolute retail buy levels and the buy skew levels, but its positioning relative to renewables dropped down a bit in March. And again, that aligns with the macro trend that it hasn't got the same degree of power price exposure, but does have more bond yield sensitivity. And obviously we've seen bond yields move up.
So we're nearly at the end here now, Ashley. It would be very helpful to get this breakdown of the sector at a more granular level, shall we say. We haven't mentioned so far the battery storage trust because they're not directly affected in quite the same way. I think when we last spoke, which was the start of the year, you were relatively cautious on what I call the mainstream renewable generators, but you thought that there was more potential in battery storage and maybe in one or two of the other more specialist instruments. Is that how it's panned out? And if so, is that still your view?
It is still my view. I guess the difference that we have seen, so within battery storage, there is still a benefit to power price volatility, albeit they're not directly exposed to high power prices on an absolute basis. And we have seen that during the Iran conflict, the average revenue achieved by a battery has increased and has increased markedly. That sort of subset to preference does remain. I guess what we have seen within the two battery funds is an announcement from Gore Street Energy Fund that effectively they will be accelerating their asset disposal plan and returning a large element of the asset base back to shareholders as a dividend. And that has had a material positive impact on their share price. So the target is potentially to return up to 30% of the market value by dividends over the next few years. So if they can execute on the disposal plan to fund that, given the degree of discount that the fund was at, that's a material positive. So in terms of that sort of two-horse race, Grid, Gresham House Energy Storage performed very strongly last year. More recently, Gore Street, because of this asset disposal and dividend policy announcement, has seen a stronger share price performance.
Is that a model, therefore, that you think Gresham House Energy Storage should also look at? Basically, it's suggesting you should shrink a bit, essentially.
Yeah, I don't think so. The businesses are different in that Gore Street is more geographically diverse. So Gresham House, UK focused, has got an investment program that had the financing in place. It has had some delays with that investment program because across the market we've had grid connection delays. So two of their projects have had about an 18-month delay, which has reduced to a degree their 2027 EBITDA target, but it's a timing delay, not a level delay. So I wouldn't necessarily suggest Gresham House should look to dispose of assets because actually it has a strong value accretive investment proposal. Gore Street with a more diverse portfolio that didn't necessarily have financing and structure in place to invest in those assets, you can understand why the relatively new board has focused more on asset disposals rather than investment.
So essentially, Gresham House Energy Story is still on its growth tack, if you like. It's cut the dividend and it's going for new investments, building up its capacity and so on. So that's, as you say, a slightly different prospect. So overall, therefore, Ashley, thank you for your time. Obviously, we live in volatile times. We don't know what's going to happen with the war or indeed with anything else. But the plates are moving a little bit. Do you think in a couple of years' time, your sector is going to be larger or significantly smaller?
I think it will be smaller in terms of number of trusts and names, but I still think we will see consolidation within the sector. So I think the average size of funds will have increased, which should help liquidity and accessibility to a broader base of investors. And then hopefully, as we see with Bluefield Solar Income Fund, I think there should be a number of transactions that demonstrate that even if it's achieved at a level below NAV, it could still be at a premium to an undisturbed share price. So I think we will see consolidation within the sector and a number of funds potentially increase in size.
But we don't yet know when that Bluefield process is going to come to a conclusion, right?
No, it should hopefully be over the next few months, so potentially in May. It's not over the line yet. Obviously a number of the changes, have had a marginal negative, in terms of the CPS and general uncertainty, but it would be good for the whole subsector to have it executed.
Indeed it would. So, thank you, Ashley, for your contribution. That was Ashley Thomas, the Renewables and Infrastructure Analyst at Winterflood Securities, talking to me on the 24th of April.
Thanks, Jonathan.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.